Hi everyone, and welcome to the video explaining the solution to practice problem number 2 for learning objective 1-2. In this problem, we have a couple things going on. So if we just read this here, on September 30th, 2024, Sternberg Company sold office equipment for $12,000. The equipment was purchased on March 31st, 2021. Okay, so they bought equipment on March 31st, 2021. They sold it a few years later on September 30th, 2024. They bought it for 24, they sold it for 12. Okay. The asset was being depreciated over a 5-year life using the straight line method. Okay, so they're using straight line depreciation, pretty common, the most common method of depreciating assets, with depreciation based on months in service. So all that is saying is they bought this in March, and so though they're not going to include in depreciation for the months of January, February, March 2021 because it was the last day of March. There's no residual value, and our job, our mission here is to prepare journal entries for depreciation and then the sale of the equipment. All right, so we have an asset disposition. All right, we have an asset disposition, which is the sale of an asset. So our mission, 1, record depreciation expense, and 2, record the sale. And to do that, we need to know the asset's net book value at the time of sale. So what is net book value? Well, I use that word net deliberately. So I'm saying net book value. Why do I say net? Well, net means like you're adding stuff together, right? And so if we're saying net, what we mean is take the asset's original value, right? So in this case, it was $24,000. That's what we paid for it. But because as of the date of the sale, right, we're selling this on September 30th, 2024, and we bought it on March 31st, 2021. As of September 30th, we had used the asset for a period of over 3 years. So it's no longer worth that original $24,000. So to figure out whether or not we got a good deal, whether or not we made a gain or a loss on this sale, we need to know, well, how does the depreciated value of this asset compare to the $12,000? Because that's the comparison we want to make. It's not $24,000 versus $12 because we've used this asset for 3 years. The asset's worth less than $24,000. To get a true comparison, we have to incorporate, we have to subtract less accumulated depreciation. Okay, so that is the part that we don't know now. I mean, we have to figure this piece out. So what is the accumulated depreciation as of 9/30/2024? And then this will give us our net book value. And so that's the number that we want. All right, so we want to compare this to the sale price of 12. That's all we're trying to do. We want to say, well, did we make money on this or not? Was $12,000 a good good price or no? And so that's all we're trying to do here. We want to say, well, we're selling this asset for 12. Was it worth more or less than 12? If it was worth more than 12, we got a bad deal. If it was worth less than 12, we got a good deal. We made a profit. We made a gain. And so we need to reflect that in our financial statements, right? Because remember, accounting is the language of business. We're trying to take events that happen in the real world and translate them into financial statements. So the real world event here is we sold a piece of equipment, right? And we're trying to translate that for people into a financial statement so that they can make a decision using that financial statement. All right, so how do we do this? How do we make the translation? All right, so the first thing we want to do is we want to figure out what the straight line depreciation rate was. So straight line depreciation is equal to the original value minus the residual value divided by the asset's useful life. Okay. In this case, we bought the asset for $24,000. The problem says there's no residual value, and it has a 5-year useful life. So effectively, 24,000 divided by 5, we get 24,000 divided by 5 gives us $4,800 of depreciation per year. And so if we think about, we bought this asset on 3/31/2021 for $24,000. And then on 12/31/2021, we record depreciation expense, but it's not for a full year. We placed this asset in service basically on April 1st. We bought it on March 31st, but we're not going to depreciate it for the month of March because we only had it for a day there. We're going to assume we're going to only depreciate it for April through December, right? The period of time between these two. So we have April, May, June, July, August, September, October, November, December. That's 9 months. This depreciation rate is per year. So I'm going to say $4,800 multiplied by 9 over 12 months. This is partial period depreciation. So if you're talking the language of business, right? So in accounting, we call this partial period depreciation, right? If you want to impress people when you go home and your parents say, hey, what were you studying in class today? And you say, nothing really, just some partial period depreciation, no big deal, right? And it'll sound real impressive. So we got $4,800. We're going to multiply that by 9, divided by 12, right? And so we're going to say $3,600 of depreciation in 2021. So I'm going to subtract this, 3,600. And then we have depreciation in 2022. And then we have depreciation in 2023. And then we're selling this on 9/30/2024. And so we have 4,800 because this is a full year in 2022, full year in 2023. And in 2024, we're depreciating it for January through September because it's the last day of September. We're going to include that. So once again, we have a 9-month depreciation period. We don't have to redo that calculation. We're just going to use that number we've already calculated for 9 months. And this will become our net book value at the time of the sale. So if we were to add up, we're basically going to add these numbers up and see what the net book value is. So let's say 24,000 minus 3,600 minus 4,800 minus 4,800 minus $3,600. So this asset had a net book value of 7,000. Ooh, gotta change to my pen here. $7,200 at the time of the sale. All right, that is our net book value, $7,200. All right, so our net book value at the time of the sale is $7,200. And now we want to say, all right, did we make a profit here? Did we have a gain, or did we have a loss? And so if we just go to a new page here to give us more room. So our sale price, we sold this asset for $12,000, and the value of the asset, the net book value. So this is net book value is the value in the balance sheet according to our accounting calculations. Because we use this asset for over 3 years, our calculations suggest to us that this asset is only worth $7,200. Okay, so we can debate what number is the right number here. Is the asset worth $12,000, or is it worth $7,200? But it's irrelevant, because all we're trying to do is figure out if we have an accounting gain or loss, right? So we're following the accounting rules, which tell us how to calculate net book value. We're following the market when we get a sale price, and we're trying to reconcile the two. We're not making a judgment about whether or not 7,200 is correct or 12,000 is correct. We're just noting that the accounting rules tell us it's worth 7,200, and the market is saying it's worth 12,000, and we have to reconcile that difference. And the reconciliation comes from recording a gain or a loss. All right, so what is it looks like we have a gain here. So what's our gain? So we're gonna say 12,000 minus 7,200. So we have a gain of $4,800. Okay. All right, so we have all the relevant information for our journal entries now. And so this question is asking us to prepare the journal entries to record depreciation for 2024. We figured out our depreciation for 2024 is right here, right? So $3,600. So we're gonna say debit depreciation expense and credit accumulated depreciation. And this again was this number right here. For 2024, it's $3,600. So we're just gonna write that in here. This is the solution to the first part of this problem. And then, now this is important. When we sell an asset, we have a couple of different jobs. So first, we have to record the receipt, so that whoever's buying this asset is paying us cash. We have to record the receipt of cash. And second, since we're selling it, we have to delete the asset. The asset and related accounts from our balance sheet. So basically, we got to, if we're selling this thing, it's no longer ours, it's no longer our asset. We have to take that asset off of our financial statements. So we need to record the receipt of cash, that's number one, and we need to remove the asset from our balance sheet, and I say, and related accounts. So what am I talking about there? Well, we have depreciation, right? We recorded accumulated depreciation. When we record this, we're saying credit accumulated depreciation. That's a contra asset account. We got to get rid of this account also. So not only do we have to get rid of the actual asset account, we also have to get rid of accumulated depreciation. So how do we do this? How do we accomplish these two steps? So let's give ourselves some room here. So first, we are going to debit the receipt of cash. So cash, we received $12,000. We got rid of the asset. So this is equipment. So we're going to credit equipment. And the value, the gross value of this equipment was $24,000. And we had accumulated depreciation, which is normally a credit. To get rid of it, we do a debit, right? Because accumulated depreciation is a credit account. It's a contra asset account. So to remove it from our balance sheet, we have to do the reverse of what it is. To zero it out, if it's a credit number, to zero it out, we have to do a debit, right? It goes back to these T accounts, right? So if we think about accumulated depreciation, we put each of these amounts, 3,600, the 4,800, the 4,800, and 3,600, we put these into this T account. Right, so I'm just gonna illustrate this, right? So this is what we did. Each year, when we recorded these amounts, we were putting them into this T account. And what is the balance of this T account? If we do 3,600 plus 4,800, so I'm looking at these numbers here, 3,600 plus 4,800 plus 4,800, 3,600 plus 4,800 plus 4,800 plus 3,600, 25,000, no, what, that doesn't make sense. What did I do here? Oh man, I fat fingered these calculator numbers. So 3,600 plus 4,800 plus 4,800 plus 3,600. $16,800. Okay. So we said we had $16,800 of accumulated depreciation. So this T account, right? What we're saying is this totaled up to $16,800, and to zero this out, we need to do a debit, right? We need to make an entry on this side for $16,800 so that we cancel this account out, right? We want to cancel this account out. We want it to go to zero. So our accumulated depreciation here is going to be $16,800. And finally, we can record our gain. Gains increase equity. To increase equity, you do a credit. And so we're going to say our gain is $4,800. And so if we add these up on the credit side, we have $28,800 of credits. On the debit side, we have $28,800 of debits. So our entry balances, we've taken care of the mission that we set out to accomplish. We got rid of the this entry here gets rid of the asset on the balance sheet. This gets rid of the related accounts, which is accumulated depreciation. We record the receipt of cash, and then this is our gain. That is what we need to balance this equation. This is what reconciles that market price, that $12,000, to what the accounting rules say this asset is worth, is $7,200. The reconciliation here is a gain. All right, so I hope you found this solution helpful. Thank you for watching. I'll talk to you real soon.